Right, so there's clarity emerging from the government's end as far as this treaty goes. But let's go across to understand a bit more on the treaty, amended treaty, what it means for FIs and the market participants. To decode that tax treaty in detail, I'm joined by Bobby Parikh, who's the partner and chief mentor at BMR Associates. Bobby, thanks very much for joining us. But first and foremost, your own analysis and sense about what the government has come out with as far as their clarification, the amendment that they've brought in. Do you think it's enough to, allay all the concerns that have earlier been raised around this?
So, the concern that at one level, the Mauritius Treaty has been around for a number of years, and there is the provisions in the treaty are relatively unambiguous. And so there's been a fairly long period of time when there was, in my mind, quite clear positions as far as the taxability of investors coming out of Mauritius was concerned. More recently, there has been some ambiguity because the revenue authorities started sort of questioning the eligibility of different companies to claim treaty relief, and so at a practical level, while the law itself had changed, there seemed to be a shift of stance that at the revenue authorities end, and that had created uncertainty in terms of whether all companies were eligible for Mauritius treaty relief, or whether there was, whether different considerations would be taken into account by the revenue, and what those considerations might be, and things of that nature. And so there was uncertainty at a practical level, although, like I said, the law itself has not changed over all of these years. So beyond all of that, I think there was also an expectation that the government would seek to renegotiate the Mauritius Treaty, because it was one of the few treaties that did provide for a capital gains exemption. Most other treaties don't. And there were all these associated sort of concerns about round tripping and whether black money was coming to Mauritius and things like that. So I guess at a sort of environment level, the concern was that the treaty was going to get renegotiated, or was likely to get renegotiated at some point in time. And it was unclear when that was going to happen. And so there was uncertainty about the durability of the treaty. To the extent that has now been, if the treaty is being amended and the taxation is now being clarified, then the uncertainty really that is getting clarified is that, when was the treaty going to get amended and whether it was going to get amended, and now that has been done.
Bobby, the most obvious question then, what happens to the P-note route now? It's been a favored form of investments for most FPIs. I believe almost 70% of all Mauritius and Singapore investments are through that route. Does this effectively shut down the P-note window?
Well, so, P-notes were not being used only for tax. My understanding is that many international investors preferred P-notes because it saved them the requirement of having to register with the Indian regulatory authorities as FPIs themselves. And saved all the associated compliance with, having to file, to report, and do all of those kinds of things. And so P-notes enabled such investors to participate in the market without having to necessarily go through all of the compliance that other FPIs who are investing in India might have to. So it was not all, it would not be correct to say that all P-note trading is essentially done in order to, avoid Indian tax. Although that was also an outcome that was getting generated, because P-notes were typically, as you said, being issued by entities based in Mauritius or Singapore, which were not liable to tax in India. So the position for P-note holders will now be the same as the position is for other investors. Do you find the market attractive enough to invest in if you have to pay some tax? Because what will happen going forward once the capital gains exemption falls away is that the return on the P-notes will be adjusted for tax that is that the transactions are liable to in India, and so the returns will get reset to account for the tax that is payable, and so and that's going to happen for other FPIs as well. So the position will not change to the extent that P-note holders were investing through Mauritius and Singapore, whereas other FPIs may not be investing through Mauritius and Singapore. Now the playing field will get leveled. But whether a P-note investor will continue to invest in India or not will really now boil down to what his return expectations are, and if those returns, when adjusted for tax, whether they are attractive enough for the investor to invest or whether they cease to be attractive. Now, that is something which will be an investment call based on what they are looking at.
Sure, Bobby, before we let you go, one last quick question. Have you been able to reach out to some FIs, FPIs who have seen this, and probably this was something we were expecting to happen, but now what is their sense? What are they saying? Are they cheering the move? Because the government seems very gung-ho that investments will increase. Do you really think that will translate?
Well, I don't know that it's difficult to make a call on that one way or the other because I don't know that this action in itself, all other things being equal, if something was not liable to tax before and it is now liable to tax, then I think that is in and of itself not favorable, right? So conceptually, if someone wanted $100 of return and now he's going to get 90. Then the investment opportunity becomes less attractive. So just on a plain confining ourselves to only this bits of information. So I don't know that this action in itself accelerates investments or will cause more investments to flow. I think then when we sort of look at it at the level of principle and say that investors generally don't like uncertainty and the fact that this treaty may get amended, may not get amended, when will it get amended, in what form will it get amended, that uncertainty is dispelled. And so when you look at it that way, then you say that, okay, there was some sort of sword hanging over the treaty that is now gone away. And so I can now make my investment decisions without having to worry about what the outcome, what this particular aspect is going to play out.
Right, Bobby. We'll leave it at that. Thank you for joining us with your perspective on that. The markets have just slipped slightly after inching towards that 7,900 level. But Swati,